manipulate or adjust cash, right? It's physical, you can touch it. The dollar amount of cash flows is 1. 2 is the time value of money, okay? So this is what we introduced earlier, and it allows us to compare money at different points in time. And the third is risk, okay? So risk tells us the uncertainty we have relating to an investment. Okay, so the reason I asked you this now is I'm going to ask you next week, and I'm going to ask you the week after, and I'm going to ask you the week after that, because every time we do a finance problem, we need to identify these 3 things. And if we identify these 3 things, we can make good financial choices. Okay, so well done to most of you. So just to elaborate on elaborate on this risk concept. Okay, so I've got a question for you. So say there was a prize for coming first in this subject. It's a $50,000 prize. However, you can only do 2 things with that $50,000. You can either invest it in Apple stock, which we talked about earlier, or you can bet it on red on the roulette table. Okay, so have a few moments to think about that and pop your preference into the chat. Okay, so just let that go. So the chat's going gangers, or sorry, the chat's going, is dinging. And many of you are saying put it into Apple. John's going red, red, red on the roulette table. Darcy's being a bit more strategic. So is Mariam. And Jason is go hard or go home. Fantastic. Okay, and Kieran doesn't like red. He wants to go green. Fair enough. So it turns out that there is no right answer to this question. Okay, so the question really depends on your risk tolerance. Okay, so what this hypothetical gets you to understand is that there is a relationship between return and risk. So what I've got here is a graph. I've got return on the vertical. I've called it expected return, but for now, it's just return from an investment. On the horizontal, I've got risk, which is also known as beta. But again, for this very first class, risk is risk on the horizontal. So I'm just going to start putting our choices on this graph here. So something that you may not have known before is if you want to make an investment in something that basically has 0 risk or no risk, an example of that is what's known as government bonds. Okay, so with government bonds, this is when you lend money to the government and they repay you that money with some interest. This is like a defensive asset, as Christian is putting it, or it's an investment which has very little risk or no risk. So you get a minimum return for taking on that risk. Now with Apple, okay, earlier from Yahoo, you can identify this information. Apple has a risk of 1.17 in terms of its beta. So clearly it has more risk than a government bond. Okay. And then if I was to put the roulette table bet on this graph, I don't have a specific number for this, but all I know is that the beta will be really high in the sense that you either win really big or you lose really big. So forget the actual precision of this type of hypothetical, but the point that we're trying to make here is simply that there's a positive relationship between risk and return. Okay, so if something's really risky, you are going to want to demand a higher return from it. And if something is not really risky, well, as a rational person, you're going to demand or expect a lower return. Okay, so Mariam, yes, so the risk-free rate or the minimum return that you can earn on investment. A good example of that is the 1 or 2% you're getting in your savings account, because chances are the bank's very likely to repay you your interest every month. And for Darcy, who's thinking ahead of the curve, you can actually calculate beta yourself. Okay, we're not going to do that in this course, it's a bit advanced, but lots of different people estimate beta. Like Yahoo Finance does it. I think the ASX does it. You can see this on their websites. Company analysts and finance people, they all do it. Okay, so you can actually do it yourself to sort of check it as well. And what is the formula for beta? We'll leave that one for now, Mariam, because it's a bit advanced. Okay, so just a couple more things to end today's class. So does anyone know what the two main types of financial market transactions are? So there's two main types of transactions. Does anyone remember what they are? Okay, so boom, from Samira, Elliot's on the right track. We've got the primary and secondary market transactions. So with the primary market transactions, these are transactions between investors and companies like Qantas, Facebook, Apple, and so forth. Okay, so primary market transactions are transactions where a company can raise money to fund its operations. Okay, and in essence, how they do this is, if you're Qantas, you sell a security. What that means is you sell a piece of paper to somebody, an investor, and that piece of paper is essentially an IOU from Qantas saying that if you invest into me, I promise to repay you. Okay, so as Darcy stated correctly, and a good example of a primary market transaction is an IPO, which is an initial public offering. So this is when a company sells shares in itself for the first time. So one that I can remember off the top of my head is the Facebook IPO. So when Facebook first sold shares in itself, it sold it at $38 per share. If you still held on to Facebook shares now, they're worth about $230 each. So you would have made a large return on that investment. And in Facebook's IPO, they raised $16 billion, which is a huge amount of money. Okay, very good. And just quickly, the secondary market transactions, they are investor to investor transactions. So for example, it could be you and me. We are buying and selling shares between one another. We are transacting money between one another. Okay. The important part of a secondary market transaction is that if we are buying and selling shares of Qantas between one another and transacting money between one another, Qantas is not actually seeing any of this money. Okay, Qantas is not raising money from a secondary market transaction. So in response to Aidan's question, so shares are an example of securities. So yeah, so shares are an example of securities. Bonds are an example of securities. Securities are basically sort of a financial paper transaction. So yes, I do use those terms interchangeably. So a good example of a secondary market transaction is when we buy and sell shares on the Australian Stock Exchange. Okay, very good. So lastly, just to wrap this up, and for some of you guys, this will be easy. And for some of you guys, I've already had some emails about the accounting stuff. So I've just got like a snapshot of Qantas's balance sheet here. I haven't put the full blown balance sheet here because it gets a bit confusing. So I've just snapshotted it a bit. But the balance sheet, the basics of the balance sheet is one thing that we need to understand for this class. So the balance sheet tells you the financial strength or position of a company, and it can be summarized by this very basic formula or relationship. Okay, and most of you will have seen this before. It's assets equals liabilities plus owner's equity. Okay, just bear with me. Okay, so the very basic relationship is assets. On the left-hand side, that's everything the firm owns. And on the right-hand side is its liabilities and owner's equity. They're the two main funding sources for Qantas or any company. So the balance sheet has to balance. So everything in terms of its assets has to equal to the amount of liabilities and owner's equities that it has. So just remember, current assets and current liabilities are anything with a term of less than 1 year. Non-current assets and non-current liabilities are anything with a term of greater than 1 year. And in terms of Qantas, it turns out that it has a lot of cash on hand, which is good.